We'll talk a lot more about this. Now, I just want to go with Steve's reference. By the way, the investment committee here at Post 9, Joe Terranova, Jenny Harrington, and Jim Lebenthal. Exciting day. The market's really popping. Just to go with what Steve was just talking about, the Clint Eastwood reference, looks like he made the markets day. We're seeing the S&P pop, the NASDAQ pop, all of them up just about 1/3%. The S&P easing back just a bit. What did you make of these prepared remarks? Steve saying it's pretty neutral. A lot of different messages in those prepared remarks. Of course, we're still waiting for the Q&A coming up.
A lot of different messages. And as Steve was speaking, all I was doing was focusing on a U.S. 10-year Treasury. Right. Would the U.S. 10-year Treasury go above 5% as Steve was talking, addressing the comments from the Federal Reserve Chairman? That's not what's happened. No. We have a 10-year down at 491 right now as we speak. I think the market, in the way that it is positioned, needed a very hawkish statement to get above 5%, because in the totality of where speculation is for the Treasury market right now, it is overwhelmingly short Treasury. So you needed to push it higher above 5%, a very hawkish statement. Sure, you didn't get that. You're sitting at 491. In the coming days, could we get something to push above 5%? Absolutely. I'm not dismissing. But where we are in this moment right now, it wasn't hawkish enough to push us above 5%, and equities are responding accordingly. Yeah, just to your point, as you mentioned, the 10-year at 4.91. Earlier today, I believe it was up to about 497 or so, at least when I was doing my show, Worldwide Exchange, easing back quite a bit. Jenny, over to you. What did you make of the prepared remarks? And again, I want to emphasize to the audience, we're going to go to the Q&A after the speech. Right now, we're breaking down these prepared remarks.
So what really caught my attention, well, first of all, the Clint Eastwood thing, when I opened, I thought, yeah, we all are. Right? We all are, all the time. As investors right now, there's so much to be nervous about. We're all sleeping with one eye open, whether it's broader macro geopolitics, whether it's, interest rates, earnings that are starting to come out. So there's a real unease. But the whole neutralness to that statement, I kind of think that's where we are. And it doubles down on me, for me, where I stand, which is, look, dovish is no good, because what does dovish mean? Dovish means that we have a weaker economy and that's going to be harder for earnings to grow off of. Hawkish is no good, because that means higher rates for longer, which caps valuations. That's no good. So all of this just kind of sets me more in my tracks on we're pretty stuck for right now, right? We really need something to give. That's maybe not even the right way to say it. We really need something to evolve, right, where we can see earnings start to grow significantly or valuations start to expand significantly. And I think the only thing that's going to get us there is the passage of time. And it's going to be a long time to get there. It's not a quick overnight fix. I mean, if you think back to 2 years ago, Frank, I was looking back at this market letter that I wrote to clients, and 2 years ago I said, hey, we've just grown at 16.5% on an annualized basis for the previous 10 years. The past 2 years, the market's perfectly flat. Why is that? Because we're digesting that outsized growth. That's going to take a long time to work off of, and we're in that process. Yeah, so important to know also the market's easing back from that initial pop after the remarks were released. Still in the green, but just easing back a bit. Jim, I'm going to come over to you.
Well, those remarks were kind of a muddle for me. I'm glad that the market popped, but that doesn't seem to me to be a really rational response there. There's not enough there to sink your teeth into. So to Jenny's point, well made just now, that it's going to be the passage of time and you're going to need some evolution here. I think we're back to being data dependent. Now, that's a two-way street, okay, because economic data is generally quite strong. I could point to the jobless statistics, the weekly jobless claims for today, and, that's going to provoke the Fed to go higher. But what they really need to see is inflation coming down. That's the soft landing. When's the next inflation reading? Well, it's a week from tomorrow. That's the PCE for September. That's the most watched by the Fed. We'll see what that comes in on. I think besides that data point, what you're looking for in the next week and a half before the next Fed meeting is, and I'm sorry to bring up a competing news outlet, but Nick Timiraos of the Wall Street Journal. He's the official Fed whisperer here. I think Steve does a fantastic job, taking nothing away from him. But when the Fed wants to make sure there are no surprises, it will go to Nick Timiraos. Now, right now, the markets are saying there's not going to be a Fed rate hike in November. If that changes in the Fed's mind, Nick Timiraos is going to be the one who brings it. So that's unfortunately what we've got to do for the next week and a half. I don't think the Fed is going to go in November, but there's not enough in that prepared remarks to make me think that we're all clear, not even close.